Nearly 1/3 or 1/4 of all homeowners in the U.S. are underwater on their mortgages.
The rate of mortgage defaults is rising, and we've learned from the government that 1 million home mortgages right now are in default or foreclosure.
9.9 million homes have been foreclosed upon since 2008. And as of 2011, there were about 14.3 million year-round vacant housing units in the U.S.
What we had was a whole financial system that were like drug pushers. They were loan pushers, and built up this whole pyramid scheme of bets and counter bets and shady investments, and sold these all over the world. And these banks made billions and billions of dollars. Goldman Sachs, Citibank, Bank of America, Barclays, you name them. And then when they went bankrupt, the taxpayer ended up having to bail them out.
The policy of the administration has been to let the housing market adjust. That has involved millions of people losing their homes, enormous social suffering, and suffering that has hindered the economic recovery, because people aren't able to get out of their homes, they're not able to sell their homes, they're not able to buy new homes closer to where they might get another job. I mean, and the whole economy is frozen up. The solution from the administration has been to encourage foreclosures.
If they buy a house that they can't afford, who do you want to pay for the house that they decided to buy? They signed their name. Who should pay for that house if they can't afford it, instead of evicting them?
These people who own subprime mortgages, most of them were not preyed upon victims. They actively sought those mortgages out.
Wall Street didn't stick a gun to your head and say, you know, go out and take the subprime mortgage and buy a $900,000 home when you don't even have $20,000 in the bank. Now the entire system is paying the price for that.
That's ridiculous. I used to work on Wall Street, and I have spent most of my career consulting to banks and major financial services firms. The job of a lender is to make sure that their loans have a reasonable possibility of being paid back. And if they made bad loans, shame on them. Many of the borrowers were affirmatively defrauded. There are numerous cases where the borrowers were told by the broker, oh, let me fill out your paperwork. And it was the broker who filled in the phony income figures. Also saw steering, particularly of minorities who could have afforded prime loans into more costly subprime loans.
They were charging folks of Hispanic or who were African American more money on their loans. Wells Fargo did not admit any wrongdoing, but they did pay the second largest fine of its kind.
It's the lender's fault that we got in this situation.
You know, in the old days, if you went to the bank for a mortgage, the bank had an incentive to look and see whether you could pay it back because it was going to be on their books. If you don't pay them back, they lose. What's happened with this increasing complexification of the financial system is that the responsibility and the incentive have gotten separated. They didn't care whether people could pay back or not, because they were just going to sell it to somebody who's going to bundle it into somebody else, who's going to sell it to somebody else, and the people who actually lent that money had no clue about the creditworthiness. And it was in the self-interest of unscrupulous mortgage brokers to go out then and just try to make a lot of money on volume. Make as many loans as they can because that's where they get their money. Who cares if it can be paid back, because that responsibility is off somewhere else.
And normally in history, when lenders were that incompetent, they went bust, and that was capitalism. And now instead we have a system where the lenders who are so grossly incompetent that they should have gone bankrupt are propped up. That's socialism for the rich, but somehow we don't call it that. To cover for the fact that we have socialism for the rich and the incompetent, we're instead blaming the borrowers to disguise that fact.
Trillions of dollars and free money being provided to our banks by the Federal Reserve.
As 9 of the nation's biggest banks reported losses of $82 billion while paying bonuses totaling $33 billion to employees.
That's where I think the government went very wrong. Because you have to keep the financial system afloat, but you do not have to keep the financiers afloat. You have to bail out banks, but you don't have to bail out the bankers. When the federal government came in and gave billions, and some say trillions of dollars to underwrite the financial system, the government then should have exerted much more control over the financial system.
We created a condition where banks could borrow from the U.S. government at some of the lowest interest rates, and this is still going on today, by the way, at some of the lowest interest rates that have ever existed in history in order to increase the flow of credit back out to the economy. That didn't happen. They sat on a lot of it.
Until a hungry world paid his price. What a patriot.
Bernanke and his cohorts believe if you fix the banks, it will trickle down to the real economy, when that hasn't happened. Right now, the zero interest rate policies that we have are literally a $300 billion per annum transfer from savers to banks, from retirees to banks. And that's before we get to the lack of criminal prosecutions.
They didn't go after the bankers. This was a policy decision not to prosecute the bankers. They didn't because they didn't want to disrupt the vulnerable banking system. You know, the banking system was so fragile, they were afraid of scaring the bankers. Well, the banks aren't lending anyway. We might as well have thrown them all in jail.
And we're seeing the effects of that, of course, then translating across the economy as that economic insecurity continues to curtail consumer spending, which has led to a less than robust recovery from the initial collapse. And what's clear is the financial sector hasn't really suffered from this at all.
So what do you do about it? Well, the first thing is you just have to forgive a lot of debt, just like we have to do in Europe. You just have to bite the bullet. These loans are not going to get repaid, certainly not at face value.
Declare that everybody's mortgage gets written down by a certain percent. So if housing values have fallen by 20%, then let's reduce the existing value of everybody's mortgage debt by 20%.
We need to restrict the role of finance in the economy. It has hit the point where it is not socially productive, that it's more of a tax. They are driven by very short-term stock market incentives, not to invest for the long term, and that's just destructive society-wide.
Limiting the kinds of financial instruments that can be put out there, putting higher capital requirements on a lot of the financial institutions, but restrict the size of the financial institutions and banks. Those are the sorts of things that can make a difference.
We had 30 years from World War II into the 70s without a financial crisis. That's very unusual in American history. The New Deal regulations were tight and they worked. And part of it is they were simple. They basically said banks can't do anything except these things. You know, savings and loans could write mortgages, investment banks could do these things, commercial banks could do those things. They kept it very simple, and that's what we need to go back to.
The financial sector is, it's an intermediary sector in our economy. It's meant to support, you know, income creation and growth and employment. It's not meant to be, you know, an end unto itself.
The tail has started to wag the dog. It should be the productive part of the economy that makes things that people use is the real economy, and finance is the thing that kind of greases the wheels a little bit. What we've seen recently through the financial crisis and the rest is the tail wagging the dog.